Before a crisis announces itself, it whispers. In these quiet streets, in the spring of 2006, houses change hands like playing cards, and everyone knows someone who has become a millionaire on paper. But the long fuse of this story was lit decades earlier, far from this cul-de-sac, when the rules of money began to bend. In 1971, the United States shuts the gold window. The Bretton Woods system, pegged to a metal that glittered with certainty, gives way to floating currencies. Money is no longer a promise of gold. It is a promise of policy. Markets swell. Credit becomes elastic. The stage is set for imagination, for innovation, and for risk to travel faster than memory. Through the 1980s, a philosophy gathers power. Markets will police themselves, rules loosen, new products bloom. The savings and loan crisis warns of excess, but the machine keeps refining itself. Finance becomes not just the servant of the economy, but its beating heart, and sometimes its thermostat. In 1999, the Graham-Leach-Bliley Act effectively dismantles the barrier between commercial and investment banking. Walls built in 1933 after a different cataclysm. Banks grow broader and taller, able to gather deposits, trade complex instruments, and sell risk all under one roof. Diversity promises safety. Scale promises strength. Temptation promises profit. Securitization turns illiquid promises into tradable bricks. A single mortgage, one family, one street, becomes a strand in a global rope. Mortgage-backed securities, collateralized debt obligations. The alphabet of ingenuity. With each slice, risk looks thinner, safer, more diversified. Ratings rise like helium balloons. Fees cascade. The machine hums. After the tech bubble bursts in 2000 and the shock of September 11, 2001, interest rates fall. Cheap money searches for a new story to believe in. It finds one with a front porch and a two-car garage. Safe as houses, they say. The American dream becomes an investment thesis. Underwriting, the old ritual of caution, becomes flexible. Stated income, no documentation, teaser rates that swell later. The pitch writes itself. Buy more house, refinance later. Home prices never fall everywhere at once. Each signed loan is another gear turned, another payoff advanced. And every risk looks smaller when it is chopped and shared. Beyond the regulated perimeter, a shadow banking system expands. Funded overnight in the repo markets, leveraged through structured investment vehicles, nourished by short-term paper. It is banking without deposits, maturity transformation without the old safety nets. As long as the lights remain on, liquidity feels like oxygen. Always there, invisible, taken for granted. Credit ratings, once a guide, become a passport. A AAA stamp unlocks the world's most cautious money. Models blend yesterday's calm into tomorrow's confidence, treating variance like a myth. But models cannot visit the kitchen tables where adjustable rates will someday reset. They cannot hear the silence after a missed payment. A world hungry for safe returns discovers American housing credit. Dollars flow in from every time zone, pooling in Wall Street's reservoirs. The demand for safe structured paper is insatiable. To feed it, supply must grow, and quality inevitably must bend. The tail begins to wag the dog. History offered a rehearsal in 1998, when a hedge fund named Long-Term Capital Management almost unraveled the system. Central banks coordinated a rescue. The morale was debated. The market heard a different message, that the system would be saved. Risk remembered comfort, profit forgot fear. Risk managers present value-at-risk charts that make the world look tame, as if the map were flat and the sea forever calm. Builders chase the horizon, pre-sales queue around the block. Each condo is a promise. Each promise is a bond. Each bond is a line item in a portfolio that thinks it is diversified because it is spread so far it cannot see itself. By late 2006 and early 2007, adjustable rates reset. Payments jump. Signs linger on lawns longer than they should. The first layer of loans, subprime, begins to sour, a faint metallic taste in the water supply. Yet the street repeats its mantra: contained, diversified, temporary. The fuse burns inside the walls. A chief executive declares, "As long as the music is playing, you've got to get up and dance." The line is breezy, confident, unforgettable. But the musicians are glancing at one another, bars skipped, tempo slipping. Somewhere backstage, a cable phrase. On August 9th, 2007, a European bank halts withdrawals from funds stuffed with American mortgage paper, citing a complete evaporation of liquidity. The phrase is clinical, but what it means is simple. Buyers step back. Prices become guesses. The overnight funding that oils the shadow banks begins to sputter. The fuse, now short, spits sparks. Liquidity is the oxygen of modern finance, invisible, vital, and unmissed, until it is gone. As dawn approaches on August 10th, 2007, central bankers reach for emergency valves. Traders reach for phones that no longer summon bids. The machine that turned promises into products begins to cough. And somewhere, inside a firm that believes itself immortal, a whisper becomes a question. What if the market does not come back on Monday? The whispers become echoes. The subprime tremors of 2007 begin to vibrate through Wall Street. What was once a contained fire in American cul-de-sacs is now a rumor of smoke in skyscrapers. And markets, built on confidence, start to doubt their own reflection. By mid-August, central banks in Europe and America pump liquidity into markets, hoping to calm the waters. The message is clear: the system must keep breathing. But beneath the surface, the plumbing is clogging, and each injection is like pouring water into pipes that leak where no one can see. In September 2007, the first British bank, run in over a century, erupts at Northern Rock. Customers fear their deposits will vanish, and fear itself makes it so. Images of long lines spread worldwide, a warning shot. This crisis is not American alone, it is global. Publicly, the message is calm. Fundamentals are sound, risks are contained. Privately, balance sheets reveal a different story. Assets no one dares to price sit in portfolios like sealed boxes. Are they treasure or ticking bombs? In October 2007, rating agencies slash once sacred securities. Investments trusted by pensions, municipalities, and banks plummet overnight. The downgrade becomes a guillotine. Trust bleeds. Doubt spreads. Banks had tucked billions into off-balance sheet vehicles, structures designed to hold risk at a safe distance. But when investors refuse to roll short-term funding, the safety nets tear. Hidden exposures fall back into the bank's arms. Balance sheets swell with liabilities they cannot sell. The year ends with cheer on the surface. Markets wobble but do not collapse. Bonuses flow, the music plays. Yet beneath the carols of December, a darker melody is building. A recession declared quietly by economists, beginning in December 2007, unnoticed by most. In March 2008, Bear Stearns, a titan of Wall Street, suffers a wound it cannot hide. Two of its hedge funds collapse, loaded with toxic mortgage bets. Investors whisper, "If Bear is vulnerable, who isn't?" In a frantic weekend, the Federal Reserve orchestrates a shotgun marriage. Bear Stearns will be sold to J.P. Morgan Chase for a fraction of its value. A storied institution, reduced overnight to a symbol of fragility. The unthinkable has happened and been papered over. The markets exhale in relief, mistaking a rescue for an ending. But out in the neighborhoods, foreclosures multiply. Home values slip. What Wall Street calls contained, families call everything we had. Through the summer, denial rules. Banks raise capital, sell shares, insist their balance sheets are strong. But whispers grow louder. Which domino will fall next? Who has the most to hide? Fannie Mae and Freddie Mac, pillars of American housing finance, backers of trillions in mortgages, are seized by the US government. The safety of the system now rests in the hands of the state itself. But this rescue is not an end. It is the breaking of the levee. And just 1 week later, the storm will make landfall with a name that will haunt history: Lehman Brothers. September arrives with the weight of dread. The storm that once flickered at the edges of Wall Street now coils above its towers. Banks whisper, markets tremble, and the air tastes of fear. The giants of finance are staggering. Lehman Brothers, founded in 1844, once a symbol of endurance. But in September 2008, the glass fortress cracks. Billions in toxic mortgages rot on its balance sheet. Creditors circle. Confidence evaporates. Through the weekend, the U.S. Treasury scrambles to engineer a lifeline. Bankers summoned, negotiations staged. Will Barclays step in? Will the government guarantee? The clock ticks toward Monday, but this time there will be no savior. At dawn, the unthinkable, Lehman Brothers files for bankruptcy, the largest in American history. Over $600 billion in assets frozen. A 158-year-old institution reduced to rubble in hours. Shockwaves rip through the global system. The markets collapse in terror. Stocks plummet. Credit markets seize. Overnight lending evaporates. Trust, the oxygen of finance, has vanished. Panic has a sound. It is the silence after a phone rings unanswered. That same weekend, Merrill Lynch escapes annihilation by selling itself to Bank of America. Once proud, now desperate. Survival comes at the cost of independence. In the shadow of Lehman, no one wants to be next. AIG, the world's largest insurer, stands on the brink. Its vast book of credit default swaps, insurance on the very mortgage securities now imploding, threatens to sink not just the company, but the entire global system. If AIG falls, the dominoes topple worldwide. The US government nationalizes AIG, pouring billions to prevent its collapse. The irony stings. The insurer of last resort becomes the patient of last resort. For the first time, Americans glimpse the scale of what is unraveling. The crisis is no longer abstract. Jobs vanish, savings erode, mortgages default. On Main Street, the domino effect is hunger, foreclosure, despair. The dream of homeownership curdles into nightmare. In late September, Congress confronts the question: should taxpayers rescue the very architects of this disaster? The proposed Troubled Asset Relief Program, $700 billion, becomes the most controversial bill in decades. Anger boils across the nation. Congress rejects the bailout. Markets implode instantly. The Dow plunges 777 points in a single day, the largest point drop in history. It is not just a number, it is fear, quantified. The fall of Lehman has torn away the illusion of safety. The rescue of AIG has revealed the rot within. The rejection of the bailout signals paralysis at the very heart of power. The financial world holds its breath. And as October approaches, the question grows louder than ever. Can the system survive? October arrives like a storm without shelter. The collapse of Lehman Brothers has cracked the foundations of global finance. Confidence, once the bloodstream of markets, drains away. What remains is fear and freefall. The crisis spreads without borders. Asian markets crash overnight. European banks stumble as American mortgage toxins surface in their vaults. The contagion is global. The architecture of finance, once celebrated as interconnected strength, reveals itself as a web of vulnerability. Credit, the invisible lifeblood of modern economies, freezes solid. Small businesses cannot borrow. Families cannot refinance. Corporations cannot roll debt. It is not only Wall Street that trembles now. It is every town, every paycheck, every hope. In Washington, fury collides with necessity. To save the system is to save the very institutions despised by the public. Lawmakers choke on the irony. To prevent collapse, they must rescue the reckless. The Troubled Asset Relief Program, $700 billion, passes on its second attempt. A lifeline thrown, but not a cure. The message is clear. Government will step in, but markets, bleeding confidence, remain unconvinced. October's markets convulse. Stocks fall in cascades unseen since the 1930s. Retirement accounts shrink overnight. For millions, decades of savings evaporate in days. The word depression re-enters the lexicon. In Europe, the dominoes fall. Iceland's banking system collapses, bankrupting a nation. Britain nationalizes its largest banks. Germany and France scramble to shore up theirs. What began in American mortgages now threatens governments themselves. In mid-October, the leaders of the world's richest nations gather in Washington. The G7 pledges unprecedented unity. No major bank will be allowed to fail. Deposits will be guaranteed. Liquidity will be limitless. The words are bold. The markets remain skeptical. Behind the numbers, lives unravel. Families lose homes, jobs, dignity. Lines form outside food banks, once rare in American suburbs. The crisis is not only financial, it is human, raw, and merciless. Executives are summoned to Congress. They speak in the language of models and market forces, avoiding the truth that burns beneath. Greed and leverage built a tower too fragile to stand. Accountability, like trust, is nowhere to be found. October 10th becomes one of the darkest days in market history. Panic selling rips through every sector. The sense is not of recession, but collapse. The abyss stares back. As October closes, the question shifts from rescue to survival. How deep can the world fall before the ground breaks? And who, if anyone, can stop it? The abyss is open, and the next decision will decide how many fall inside. Winter approaches, and with it, the chill of fear. The markets reel, the economy contracts, and for millions, the Great Recession is no longer a phrase. It is daily reality. Unemployment rises, savings vanish, and the question of rescue becomes urgent. In the midst of turmoil, America chooses new leadership. Barack Obama is elected the 44th president. Hope surges in the streets. But markets wonder, can even new leadership turn back the tide of collapse? The Troubled Asset Relief Program, or TARP, becomes a weapon of survival. Originally designed to buy toxic securities, it shifts strategy, direct injections into banks. Billions flow into institutions that days earlier denied weakness. Under pressure, 9 of the largest American banks accept government capital. They are told it is mandatory to save the system and mask who is weakest. For the first time in modern history, Wall Street giants are wards of the state. Yet the injections are not enough. By late November, Citigroup teeters on the brink of collapse. Its sprawling empire of mortgages and derivatives has become a sinking ship. Another massive bailout follows, hundreds of billions in guarantees. The precedent is set, too big to fail. The crisis spreads beyond banks. The auto industry, backbone of American manufacturing, faces extinction. General Motors and Chrysler plead for government rescue. The debate intensifies. How far should taxpayer lifelines reach? The United States is not alone. Britain nationalizes Royal Bank of Scotland. Europe launches bank guarantees. China unveils a colossal stimulus plan. The world unites in desperation. Rescue by any means. For the first time, the G20 convenes as a crisis council. Leaders from advanced and emerging economies pledge to reform global finance, strengthen oversight, and prevent another meltdown. Lofty promises in the heat of emergency. The numbers on screens hide the pain on streets. Millions lose jobs. Millions more lose homes. Foreclosure signs multiply. Soup kitchens overflow. The human face of the crisis grows sharper with each passing week. The Federal Reserve slashes rates to near zero. Trillions are funneled into emergency lending programs. The central bank becomes lender of last resort to banks, businesses, even foreign institutions. Unprecedented measures for unprecedented times. Yet, as winter deepens, revelations of Wall Street bonuses spark fury. While families lose homes, bankers celebrate survival with champagne. The gulf between Main Street and Wall Street widens into a canyon of rage. As the calendar turns, America prepares to hand power to a new president. Barack Obama inherits not only wars abroad, but an economy in free fall at home. The question now, can leadership and faith be restored before the system collapses completely? A new president steps into history's storm. Barack Obama swears the oath of office as the nation sinks into its worst economic crisis since the Great Depression. Hope fills the air, but so too does desperation. By early 2009, the economy is in freefall. 500,000 jobs vanish each month. Home values sink, retirement accounts are gutted, factories shutter. The American dream feels suspended, waiting for rescue. In February, the new administration unveils the American Recovery and Reinvestment Act, nearly $800 billion in spending and tax relief. A modern New Deal designed to jolt the economy awake and restore faith in tomorrow. Stimulus dollars flow into infrastructure, schools, healthcare, and tax relief. For some, it means a job saved. For others, a brief reprieve. The plan is vast, but the hole in the economy is deeper still. The administration imposes stress tests on the nation's largest banks. Can they survive under worst-case scenarios? The verdicts will decide confidence. Are these giants solvent or hollow shells propped by hope? Across the nation, rage simmers. Taxpayers watch their dollars rescue banks that continue to pay bonuses. Families ask, where is our lifeline? Trust in institutions, the banks, the government, even capitalism itself, erodes. By March, the stock market hits its lowest point in over a decade. Retirement dreams collapse with it. The abyss has been reached. The question is whether the system can climb back out or sink deeper still. World leaders unite in London. They pledge trillions in coordinated stimulus, stronger regulation, and reform of the financial order. For the first time, emerging economies share the table as equals in shaping the rescue. By spring, cautious optimism returns. Economists speak of green shoots, the first fragile signs of recovery. Lending inches open, markets stabilize, confidence stirs. But these shoots are delicate, easily crushed. For families, recovery is uneven. Some find relief in modified loans and new jobs. Others face years of foreclosure and unemployment. The wounds of the recession run deeper than any quarterly report can measure. On Wall Street, stability returns faster. Profits rebound, stocks climb, bonuses reappear. To many, it feels like déjà vu. Has nothing been learned? The divide between recovery for the few and struggle for the many sharpens the sense of injustice. The economy is breathing again, but at what cost? Trillions in debt, vast public anger, a nation divided over whether rescue was salvation or betrayal. The price of recovery has only begun to reveal itself, and the scars will shape the decade to come. The financial bleeding slowed, but the human wounds